So your property's gone up in value. Therefore, it should be easy to upgrade, shouldn't it? For a lot of people right now, it's actually harder. And for some, it's not just harder, it's mathematically impossible. Meet Sarah and James. Healthcare and project management. Combined income $160,000. They own their home and have built $400,000 in equity. In almost any other era, they'd already be in their next house. So let's quickly look at the numbers. The current property valuation $900,000. They have an equity of about $400,000 with an outstanding mortgage of $500,000. So their target home is a 1.4 million family home in a Melbourne school zone. A better catchment, room to grow. That's not an inspirational number. It's at or below the median for Melbourne's most sought after school catchments. The deposit is covered. They'll use the $400,000 equity that they have, which means the new mortgage is around $1 million. That sounds manageable, until you look at what servicing $1 million actually costs every month. A $1 million mortgage at current rates is roughly $6,200 a month. Remember their take-home pay? Around $10,000 a month, depending on HECS and tax. So $6,200 goes to the mortgage. That leaves $3,600 for everything else. Groceries, car running costs, council rates. That's compression right there on the page. Their current mortgage, $3,100 a month. The new one, $6,200. That's the repayment gap. An extra $3,100 permanently. Not because they've done anything wrong, not because the property isn't worth it, but because the income that they have hasn't kept pace with the debt they need to carry. And the bank, before approving any of this, stress tests them at 3% above the loan rate, which means they're being assessed on repayments of over $8,000 a month on a take-home pay of $9,800. The bank isn't asking, can they afford the mortgage? The bank is asking, can they survive if rates go up another 3%? And on a combined income of $160,000, trying to borrow $1 million, they're right at the ceiling. One more variable, the Reserve Bank moves rates up by 1%. Just 1%, their monthly repayments goes from $6,200 to roughly $6,850. That's an extra $650 a month. Every month. That extra $650 a month doesn't sound like much until you realise it's money Sarah and James simply don't have. This is not an edge case. If this is the experience on $160,000 with $400,000 in equity, picture what it looks like for a household trying to do this from scratch. The bank stress test them. They pass. The bank is protected. Sarah and James are on their own. That's a system. This system is designed to ensure the lender is protected first. The data you're being shown and the pressure you're living are measuring two completely different things. The data measures completed transactions. Your reality is shaped by everything that doesn't happen. The deals that fall over, the loans you didn't qualify for, the properties you can't afford. None of that shows up in the headline number, but it shows up in your life immediately. It hits differently depending on where you sit in the market. There are 4 positions, and you'll find yourself in one of them. First, the upgrader. You bought years ago. You've got equity, and on paper, you look fine. Equity grows, so does the price of the next property and what the bank will lend you, which is calculated on your current income, which hasn't kept up with either. So the gap between where you are and where you want to be is wider than it looks on your last bank statement. You're not stuck, but you're more constrained than the equity figure suggests. You've already seen what that looks like. That's not a case study, that's you. Same system, different pressure. Now let's look at the investor. The numbers that worked in 2015 don't work in 2025. Not without significant equity behind you. Yields haven't kept pace with prices, interest costs have risen sharply, and the extra margin banks add to make sure you can handle higher repayments means what you can borrow for any investment property is materially lower than it was a decade ago. Which doesn't mean that property investment is dead. It simply means the era of easy leverage is over. In Victoria alone, nearly 25,000 rental properties left the market in 12 months. Investors built their model on a leveraged era that no longer exists. The investors navigating this are asking a different question. They're not asking, how do I maximize what I can borrow? They're asking, how do I structure what I already have? Because in this environment, the advantage isn't leverage, it's clarity. Clarity on what your existing equity can do. Clarity on yield, versus capital growth in your specific market. Clarity on the tax structure that makes the numbers work in 2025, not 2015. The investors who understand that are making very different decisions than those who don't. Same system, different decisions. Now the downsizers. The kids have left, the house is too big, and it's costing you more to maintain than it should. On paper, you're wealthy, your property has made more money in the last decade than you have. But the moment you think about selling, the calculations get complicated very fast. That's the capital gains question. The stamp duty on the next purchase. The timing decision. Do you sell first or buy first? The lifestyle question. Where do you want to actually live? And underneath all of that, the market you're selling into and the market you're buying into, they are both moving. Not always in the same direction. The system doesn't make it easy to exit. And the longer you wait for the right moment, the more the decision costs you. For you, the constraint isn't borrowing capacity, it's the cost and complexity of moving. Same system, different exit costs. 4 different positions, one shared problem. Same system, same constraint. It rarely becomes clear until it's already cost you something. The market isn't heading for a crash. I said that in video 1, and it still holds. It's not about the surge either. What this borrowing squeeze actually means for what comes next comes down to 3 things. So the question isn't what the market does next, it's how you move inside it. First, this problem doesn't self-correct quickly. Wages don't move fast enough. Lending standards don't loosen overnight. And when they do, prices absorb the extra capacity almost immediately. Which means the affordable gap doesn't close. It just shape shifts. Sometimes it looks like prices are stalling. Sometimes it looks like rents are rising. Sometimes it looks like regional markets heating up as people chase affordability. And with the increased cost of petrol, some of the regional markets could well be hit. The March 2026 Coality data shows exactly this. Perth's up 2.5% in a single month, while Sydney fell and Melbourne softened. That's not a coincidence. When borrow capacity hits a ceiling in the major capitals, demand relocates. When people can't borrow for a house in Sydney, they don't stop buying. They move to a regional market or they stay in the rental market. Second, don't ask how much will the bank give me. Ask how much can I actually live with. How much I can actually afford to live with. If you're going to move in this market, this is the question that matters. Not what the bank will lend you, what they can actually service across a range of scenarios. Rate rises, income changes, life changes. The borrowers who stress test themselves before the bank does it for them are the ones who don't end up trapped. Third, the next variable that changes everything is interest rates. When rates move, how much people can borrow moves. When how much people can borrow moves, price ceilings move. When price ceilings move, the entire market resets. That's not a price increase, that's a structural shift. And now you've seen the maths behind it. Sarah and James did everything right. The system just changed the rules while they were playing by them. If this video helped you see something that wasn't clear before, please share it with someone who needs to see it. And if you want to understand the property market from a different perspective, from someone who's had 3 decades in the property industry, why not subscribe so you don't miss the next video? I'm Barry Muskell.